commodity and hedge fund desk major in major iBank in New York, Toronto, London, and Hong Kong. Tariq holds a master in financial engineering at the University of California at Berkeley, and he also teaches about fixed income and alternative investment at business school in Singapore to professional funds manager and private bankers. So it aims to make a global market better and understood and better used through investor education. We welcome any questions during the webinar. You can feel free to raise your questions over the chat, and Tariq will answer your questions at the end of the webinars. And thank you, webinar. Thank you, Tariq, for joining us today. So I will pass the time for Tariq now. Are you ready, Tariq?
I'm ready.
Okay, that's good. Thank you.
Excellent. Do you see my screen? Can you make it full screen?
Not yet. Now we see it.
Okay, good. Can you see the title slide?
Yes, Tariq, would you go back into PowerPoint? What we are seeing. Well, go ahead. Tariq, in PowerPoint, if you go to the View menu, please turn off Presenter View.
I'm not sure if the issue is with that or if you can see, but yeah, it's saying showing screen, and I'm not sure if they see the screen as this, but anyways, we can go ahead and walk through the slides here. As Myron mentioned, my name is Tariq Dennison. Thank you very much, Myron and Cynthia from Interactive Brokers for having me on. Today, I'm going to be talking about currency hedging and FX trading strategies using SGX listed futures. I'm going to be talking a little bit about the background on the currency markets and how different currency markets operate, some strategies of why you might want to get involved in the currency markets and why you might want to do some currency trading, and ways that you can use SGX listed futures to access currency markets with institutional pricing, even if you don't have ISDAs and other institutional type of arrangements set up. So first of all, I want to present the required disclaimer. And now here's a separate disclaimer by Singapore Exchange. So as mentioned, a bit more background on me. I am one of the advisors you can find in the Interactive Brokers Investor Marketplace. I manage client accounts on the Interactive Brokers platform through two separate legal entities, depending on where the client account is located. For client accounts outside of Hong Kong and Macau, they are managed by my US SEC-registered RIA, GFM Asset Management, LLC. So this covers my clients in mainland China, Southeast Asia, and North America, as well as institutional clients who want me to help them invest in Asia mandate portfolios. And my Hong Kong advisor is an SFC Type 9 licensed company based here in Hong Kong, serving clients based in Hong Kong and Macau. I'm a certified financial planner with the IFPHK here, and I've been in global markets since 1999, having worked at investment banks, including Commerzbank in New York, London, and Frankfurt, Bear Stearns, JP Morgan, Canadian Imperial Bank of Commerce, and Societe Generale. I'm the author of the upcoming book, Invest Outside the Box, Understanding Diverse Markets and Strategies, of which there is a whole chapter on currencies, currency markets, carry trades, and other currency hedging strategies. Now, first of all, when we want to talk about currency strategies and currency markets, the first thing to talk about is how big they are. Some people get very excited and very interested in currency markets because in many ways they're one of the most accessible, most obvious. If you reach into your pockets right now, chances are you have cash in at least one currency. And depending on where you're based, you may have other currencies for where you may frequently travel across the border or do business in other places. For example, those based in the US who frequently go to Canada or Mexico would obviously be familiar with exchanging their money into Canadian dollars. Here in Hong Kong, we very frequently will have Hong Kong dollars and renminbi in our pockets. But even that doesn't really give an idea of how enormous foreign exchange markets are. This first slide shows what the overall daily trading volume on a daily basis is of different foreign exchange instruments. And since 2001, it has grown from $1.2 trillion a day to, in 2016, foreign exchange markets traded $5 trillion US per day in daily volume. Very few asset classes of any other kind, whether you're talking about bond markets or stock markets, have anywhere near that volume. Now, granted, there's probably going to be some degree of double counting there when you have Wells Fargo buying yen from Citibank and then turning around and selling it to HSBC. But the overall volumes, when they're added up, are truly enormous. These break down into different types of foreign exchange transactions. So in 2016, of that $5 trillion per day, an average of $1.6 trillion a day were in spot transactions. So a spot FX transaction is where we make the trade today and we settle the trade within 1 to 2 business days. So it's really meant for currency conversion that happens in bank settlement timelines. Spot transactions should not be confused with cash transactions, which are the more pedestrian ones you may be familiar with, where if you go to the airport and you give them $100 and they right away give you 11,000 yen, that's called a cash transaction. Whereas large, very tightly priced transactions between banks are called spot transactions and settle in 1 to 2 business days. The next 2 categories are what are called outright forwards, foreign exchange swaps, and currency swaps. Sorry, I meant to say the next 3 categories. And effectively what those are, outright forwards and foreign exchange swaps are contracts where instead of settling in 1 to 2 business days, I will go ahead and I will buy yen from you today, but instead of receiving it in 2 business days, I may receive it 1 month from now. An outright forward is one where I'm actually outright doing the trade that I just described. I want to buy yen forward, so we've agreed that 1 month from now, I'm going to deliver you dollars, and then you're going to deliver me yen. Where the following one on that list is a foreign exchange swap. A foreign exchange swap is effectively a spot transaction paired against a forward transaction. So in this case, what it might be is I might sell yen to you spot and then buy it back forward. So in other words, the transaction would be the equivalent to me lending you yen for 1 month and borrowing dollars for you for 1 month. Foreign exchange swaps are effectively ways of managing the different interest rates between 2 currencies. And I have a slide later explaining an example of a foreign exchange swap and how differences between 2 interest rates affect forward rates. Currency swaps are cross-currency swaps between 2 different currencies, where rather than, let's say, for example, I want to buy yen and I want to sell US dollars. Let's say, for example, I want to borrow in US dollar LIBOR and I want to pay in yen LIBOR. So it's a swap. These are typically longer term transactions used by banks and used by other borrowers in order to swap a loan that's made in one currency for a loan in another currency. A very typical example of this would be, let's say, a Chinese company who wants to go out and raise money in US dollars, but then they need to swap it back into RMB in order to actually fund the operations that the money was borrowed for. So the next slide, we show the breakup of the size of this $5 trillion a day market. How does it split up among different currencies? One thing you look at when you look at the split of different currencies that are traded, the sum total of all of the percentages will add up to 200%. And the reason for that is every currency trade is a trade between one currency and another currency. So in the case of the US dollar looks like it makes up about 70% of global FX trade because it's going to be on one side of most trades. In general, when people talk about trading the euro in the FX markets, they often mean they're trading the euro against the US dollar. Or if they're trading the Canadian dollar, they're trading it against the US dollar. There are also crosses where, for example, you could be trading euros against pounds, or you could be trading euros against Swiss francs. And those are all added up in the total here when we look at the total. But by far, the dollar is still the world's reserve currency, and most of the currency trades, most of the currency pairs we're going to be looking at have the dollar on one side. So dollar versus euro, dollar versus pound, dollar versus Aussie. Obviously, there are places where crosses are more important in more tightly knit areas. So as I mentioned earlier, the case of the euro versus the pound is just as important to pair to the pound as the pound versus the dollar. The reason is of course, Britain trades a great deal with the Eurozone. A little further down the list, you'll see the next most traded currencies include the Aussie dollar, the Brazilian real, the Canadian dollar, Swiss franc, Swedish kroner, and Japanese yen. Now, the other parts of this slide, you'll notice on the left, what we're looking at is we're looking at currency, we're comparing the relative volume of interest rate futures versus the volume of currency futures. So the much larger volume on the left, these are contracts which you may hear about called Eurodollar futures or Euribor futures or LIBOR futures. This would be if you wanted to lock in interest rates for a certain period of time. Let's say you believe that US dollar interest rates are going to be rising. You will buy a strip of these contracts to lock in your interest rates at quarterly intervals. So Eurodollar futures contracts are some of the most liquid futures contracts in the world, because if, for example, you have a floating rate loan and you want to swap it into a fixed rate loan, you could trade a swap with a bank using an ISDA agreement. But if you don't have an ISDA agreement, you can simply go to an exchange and buy a strip of these interest rate futures contracts. On the right-hand side, though, are the contracts we're going to be talking about in this presentation, which is futures contracts to actually buy a foreign currency. So on the left side, what we were looking at is we're looking at interest rate futures to hedge US dollar interest rates, whereas on the right side, we're looking at currency futures where the US dollar is being traded against another currency, say against euros or say against British pounds. Now, why would we want to consider currency futures? So most of the volume in the futures, in the currency markets, as we're going to look at later, is actually in spot and forwards. It's not in futures. But let's say, for example, you're a smaller investor, you have a smaller account. You're not a large bank, you're not a large multinational corporation with an ISDA agreement with a bank, but you want to trade, let's say, 100,000 US dollars, and you want to convert it into yen. If you wanted to do that with a bank, chances are they would give you a relatively wide, relatively bad exchange rate, pretty typically about 1% off, even for about 100,000 US dollars. Once you start talking about 1 million or 10 million US dollars, you can start getting a better and better rate, but still, smaller customers tend to get much worse exchange rates, even in the spot markets, but then especially in the forward markets when they try to exchange currencies. If, on the other hand, you went to the futures market, and let's say, for example, I wanted to exchange dollars for yen, or I wanted to lock in an exchange rate, a yen FX rate, you'll get the same pricing for one yen for futures contract of about 100,000 US dollars notional, as an institutional investor trading 10 contracts or 20 contracts would get. Also, when we start talking about the difference between spot and future contracts, if you roll from 1 month to the next, it's a way for you to access that foreign interest rate also at institutional interest rates. So one example I'm going to be showing later is the difference between borrowing money on margin, even at Interactive Brokers' low margin rates, to buy renminbi denominated stocks, versus converting your money and using futures to hedge the same FX exposure. And the difference with using the FX futures is that you get the much lower institutional rate of around 3% instead of the margin rate of 6%. You can also use currency futures to access harder to trade currencies. If, for example, you wanted to trade the Indian rupee or the Korean won, those aren't currencies that are freely convertible or freely tradable. But you can earn the higher interest rate of holding Indian rupees by buying and rolling Indian rupee futures in a strategy we're going to be talking about a little bit later on. And all of the margining and settlement is handled by your standard futures account with daily mark-to-market handled by the exchange. So there's no need to have a separate ISDA agreement or CSA agreement and have a separate back office department worrying about your collateral settlement. That's all happening in your Interactive Brokers account against the exchange. If we look at the volume, so this is where I confused a description 2 slides ago with this one. This is the volume of the OTC foreign exchange turnover. So of the currency pairs of, let's say, the US dollar versus other currencies in the spot market, showing you which are the, in this case, about 12 most commonly traded currencies in the world. This is the slide that I meant where all the percentages will add up to 200%. And you can see also how the percentages and the ranks have changed over time. So here, the US dollar accounts for about 87.6% of all currency pairs. And then, again, that's because it wouldn't account for 100% unless it was in every trade. But the euro trades against the pound and against the Swiss franc in some of the trades. whereas the euro, the Japanese yen, the British pound, and the Aussie dollar are the second, third, fourth, and fifth most commonly traded currencies. Some relatively small currencies that you might not expect to see in a top 10 list of anything, such as the Swedish krona, Singapore dollar, and Hong Kong dollar, are among the world's most traded currencies, simply because there's a lot of corporate need to convert money in and out of those currencies for trade, for banking, and for settlements. One line that I want to highlight here is if you look about halfway down the list at the line for CNY, which is the Chinese yuan renminbi, which is a slightly more interesting currency in that it has both a domestic market within mainland China and an offshore market in Hong Kong and an NDF market where there are forwards that are traded and settled in US dollars that don't actually settle into renminbi. Back in 2001, it pretty much made up 0% of the global FX market. And over the past 15 years, up until 2016, it's now the 8th most traded currency in the world, making up 4% of the daily $5 trillion a day FX trading volume. So being able to have futures access to hedging renminbi is becoming increasingly important for those who have China and China currency access to their portfolios. The next 3 slides, I'm going to give a bit of a history background to 3 different types of currencies. So when I look at currency as an investment, or when I look at currency as an asset class, I find it very important to think of which currency you're looking at in one of these 3 categories. There is a question sometimes of, is currency an asset class? I personally don't consider currency a separate asset class because every investment you make is going to be denominated in a currency. If you buy a US stock, that stock is going to be denominated in US dollars. If you buy a dim sum bond, it's going to be denominated in renminbi. The real asset class you're buying there is the stock or the bond, and it will have currency exposure, which we can talk about hedging later. But this first chart is a chart from the Bank of International Settlement of 3 currencies going all the way back to 1953. And these are what I call the ABC currencies: the Australian dollar, the British pound, and the Canadian dollar. And these are the types of currencies most people think about when they think of large, major G3 FX markets. They're thinking of currencies of developed economies, they're relatively stable, and that they tend to be range-bound over a while. You think of dollar-euro, for example, it swings back and forth between 1.1 and 1.4, and it goes up and down, but it's not as though over the very, very long term we expect it to get much stronger or much weaker over time. In this case, we noticed with the Australian dollar, it got really, really strong in the 1970s, and then it became pegged to the British pound, and then it became weaker after that, and then it strengthened from 2001 to 2013 during the commodities boom. But more or less, it's remained in a range of between 70 cents and $1.10 over the long term. Same exact thing with the Canadian dollar. You often think of the Canadian dollar as strong when it's at parity with the US dollar and weak when it's 1.4 to the US dollar, and vice versa. So these 3 currencies are the category of what I call the range-bound currencies. The next type of currency I look at are the ones where you may actually want to keep your money over the long term if you feel currencies like the US dollar are on a track to being devalued, or that US dollar deflation is less. Here I've blocked it because I want to give those of you viewing these slides a chance to guess which these 3 currencies are. So here I've started the chart back in 1969, although these 3 currencies really only started floating in 1971. And as one clue, the green currency on the chart only really started floating in the late 1970s, early 1980s. But these currencies are the ones that I call the appreciators because they have increased in value anywhere between double and 4 times over the past 40 years that the currencies have been floating. So I can give you the hint of one of them. One of them was at 5 to the US dollar back in 1971, and is currently trading at parity with the US dollar. One of the other ones is probably, the other 2 are probably a little bit more obvious, but they're Asian currencies which typically run budget surpluses and have run very, very tight monetary policy. I want to go to the next slide first and have you look by contrast at the class of currencies I call the depreciating Asian currencies. And then I'll go back and reveal the answer to the first one if you wanted to guess. So within these Asian currencies, I can divide these into 2 categories. The top 3 you can look at are ones which had an obvious event which shook them up in 1997 during the Asian financial crisis. They were very, very stable and pegged for a while, and then they were dramatically revalued in the Asian financial crisis, but then they became stable again after that. So in a way, it's almost as though these three currencies looked like range-bound currencies for most of their history, except for that one offset in 1997. On the other hand, there were three other Asian currencies that you can see that have long-term declined over time, that have gone from a value of 100 and lost about 80% of their value over the same period. So I'm not sure everyone likes guessing games quite as much as I did. I did mention the first three were the ABCs, but the appreciators in this case, the red line is the Swiss franc, the blue line is the Japanese yen, and the green line is the Singapore dollar. And these are ones where if you followed the trend of these currencies over time, you would have seen how they would have changed. On the other hand, in this slide here, the three range-bound currencies are the Malaysian ringgit, the Thai baht, and the Philippine peso. I'm sorry, actually, the Philippine peso is one of the big depreciators there, whereas the red and the orange line are the Indian rupee and the Chinese yuan renminbi. You can notice the pattern with the renminbi just in the most recent years. So since 2005, it's become one of the appreciators. But for most of its history, up until 2005, it was a depreciator. Back in 1980, it was about 2 renminbi to the US dollar. And then it weakened all the way to 8 renminbi to the US dollar. And only recently are we thinking of it as around 6.5 to the US dollar. So that's the background on how these different currencies have appreciated or depreciated over the long term in the past. Looking in the future, how would we actually trade one of these currencies if we didn't have a spot market or an ISDA lined up? So the top 3 currency futures traded on the SGX by volume are the ones for the CNH, that is the renminbi, they're the Indian rupee, and the Singapore dollar FX futures. So on the CNH futures, those are in competition with the ones with the contracts at the Hong Kong exchange. Difference is one is physically settled, one is cash settled, but they are competing to be the 2 most liquid contracts for trading the renminbi on a forward basis. And I'm going to show in a bit how that means you can access higher renminbi interest rates or use it in order to hedge a renminbi position. The Indian rupee is the second most traded FX futures contract on SGX. And this is going to be useful if you want to access higher Indian interest rates, say the equivalent of having an offshore Indian rupee bank deposit, or hedge a position in India that you have in Indian rupees. And the third one is the Singapore dollar futures contract, which you may have either, again, to hedge an offshore position, or perhaps because you believe the Singapore dollar is a stable long-term place to maintain value. We can debate about how good a store of value the Singapore dollar is versus Bitcoin futures offline. Now the CNH, if you go to the screen on the Singapore Exchange, and I have the URL up at the top, you can see what a string of quotes are for different contracts and what the volume is for each of these contracts. So unlike equity futures, where almost all the volume is going to be in the front month and then everybody's simply going to roll it, it does make sense in the case of currency futures to look at longer dated contracts and consider trading not just the front month, but trading a contract perhaps 6 months or even a year out. So if you look at these futures, what this contract is it's giving you what the price is for 100,000 US dollars in renminbi terms going out to the expiration date on this contract. And if you look at the last price, so you can see the bid and the ask on any trading day, but usually when I compare 1 month to the next, I like to look at what the last prices were for each one or what the end of day settlement prices were. You'll notice that the prices are going up over time. So that does not mean that the market expects the renminbi to necessarily continue weaken. That's purely because interest rates in renminbi are higher than they are in US dollars, as I will show in the next slide. So imagine that you had this. On one side of the contract, you have 100,000 US dollars, and then let's say the spot FX rate at the time was 6.6225. So for your 100,000 US dollars on one side, you have 662,250 renminbi on the other side. Let's say right now the US dollar interest rate for, let's say 1 year in this case, is 1.125. and the renminbi interest rate for the same 1 year is 3.75%. So what does that mean that those two piles of money are going to turn into in the course of 1 year? After 1 year, the $100,000 is going to become $101,250. And then after the same 1 year, the RMB at the 3.75% interest is going to grow to 686,981. So what that means is that those two different interest rates, if you were to convert the same two piles, you no longer have the 6.625 exchange rate you started off a year ago. Your FX rate 1 year forward is 6.7850. That's not to say that's what the rate will be in the future, but that's the rate at which you can trade it now for the amount of money being settled in the future. The way of thinking about it is that you effectively at the beginning you have two choices. If I have US dollars, I can either buy my renminbi forward and then keep my money in US dollars and earn US dollar interest. And when I do that, I'm going to buy my renminbi at a cheaper price. I'm going to get more renminbi for the dollars by doing that. Or on the other hand, I can convert my money into renminbi now, and I can earn that higher renminbi interest right now. If you go back to the previous slide, you'll effectively see that 1 year interest rate, that 6.78, effectively reflects that difference in the two interest rates, and that's how you see it. We're going to have a sample later where I actually show taking a US Treasury and convert it effectively into a dim sum bond using these futures contracts. So this was something which I think was very heavily shared on Twitter and on LinkedIn when the SGX CNH cash settled contracts had suddenly become more liquid than the Hong Kong Exchange's physically settled CNH contracts. So earlier I was showing that the SGX contract had a total volume of about 4,800 that particular day, with about 7,400 contracts open interest. Again, that's $100,000 notional per contract. By comparison, this January 18 contract only had 116 contracts of volume that particular day. You may find that a little strange given that Hong Kong is the gateway to China, is basically the big renminbi trading hub of the world. But most of the renminbi trading occurring here within the city of Hong Kong still happens over the counter. And many of the institutions I've talked to here haven't really come to use futures markets. Now, the second most liquid futures contract on the SGX, second most liquid FX futures contract on the SGX is that on the Indian Rupee. And just like with the renminbi, you see a difference in exchange rate over a 1 month or a 1 year period, purely reflecting the fact that Indian interest rates are higher than US interest rates. You will notice that if you were to back out the effective interest rate on the Indian Rupee futures contracts, the implied interest rate is actually quite a bit lower than what you would get onshore in India. And the difference can be explained between the difference between an onshore India interest rate, which to earn you would actually have to go to India, convert into onshore rupees, and then pay Indian taxes on, versus the offshore rate, which is basically completely outside the Indian banking system and completely outside the Indian tax system. So this is one reason why NRI clients sometimes who want to maintain exposure to the rupee and earn higher rupee yields, but want to keep their money offshore in a place like Singapore or the US, might use these contracts to do the exact same thing. One disclaimer, which I just want to repeat earlier, I do not give tax advice. So we mentioned the first two, Indian rupee and renminbi. Number 3 is the Singapore dollar, but you'll notice by contrast, it trades almost nothing. So really the two FX contracts, even though the other ones are listed, those are, Indian rupee and Chinese renminbi are really the two that trade. The Singapore dollar contract is there, but on this particular day that I looked it up, the total volume was 3. The total open interest was about 1,600 contracts. And my guess is you're probably talking about a few major traders who use this for their regular hedging. Just on the next slide, for reference, I took a snapshot of some of the other currency futures that are listed on the SGX. The SGX is one of my favorite futures exchanges purely because it does list a nice variety of different Asian markets, both their equity futures and their currency futures. And I like the fact that I can trade Korean won, Indonesian rupiah, Malaysian ringgit, Thai baht, Philippine peso, and Australian dollar futures contracts in theory here even though, as you can see, there isn't always that much volume or that much liquidity. That said, is that if they do get a mark-to-market on yen price there, I can get an idea of what the effective offshore interest rates are when I look here. Now, one of the biggest competitors to SGX in FX futures is really not the Hong Kong exchange, but is actually the CME. So if you were to look at dollar-based traders based in the US, perhaps even trading on the Interactive Brokers platform like I do, they will be looking at any given time if they wanted to trade, let's say, the Australian dollar. Should we trade Australian dollar on the SGX, or should we be trading it on CME Globex? But whereas the SGX has more coverage of Asian currencies, especially renminbi and rupee, but also Indonesian rupiah and Malaysian ringgit, the CME also has other coverage of, say, the Mexican peso and the Russian ruble, which are currencies that there isn't quite as much interest in out here as there is in North America. So now I'm going to be talking about three specific trade ideas, three specific trading strategies that you might want to implement using currency futures rather than using spot or other strategies. Strategy number one is one of the most obvious, which I mentioned earlier, which is an outright trade or a carry trade. So the simple example here is, let's say that I want to earn the higher 3.7% renminbi interest rate rather than the 1.2% US dollar rate. Well, I can either go to my local bank and convert my US dollars to renminbi and put it in a deposit there, but maybe if they're not offering me 3.7%, maybe they're only offering me 3%, I can instead go here and let's say put my money in a higher yielding US bond, and then buy the renminbi forward using the futures contract to earn the renminbi pickup there. I'm going to show on the next slide how you can do that with the US Treasury, but you could do the same exact thing with a US dollar high yield bond. And that can be an advantage if you find that there's difficulty finding good credits or finding good bonds of other issuers denominated in renminbi, but you want renminbi currency exposure. So the driver for this simply is that you want to earn a higher yield. You basically want to get a 2.5% yield pickup with renminbi exposure, plus perhaps you believe that renminbi is going to strengthen against the US dollar as it has over the past year. One of the drivers for the US dollar weakening would be a continued monetary easing. Now, this is where you may find it a little bit strange. Over the past year, the Federal Reserve has actually been tightening, but despite that, the dollar has been weakening. So in many ways, that may be a play on, is the Fed going to continue tightening at the pace that we all believe, and is it going to be tightening more than other central banks, say the PBOC or the ECB? Another driver is if real interest rates in your target currency, in your long currency, are positive. So a big driver here in, say, the Indian rupee would be if inflation in India falls. One of the reasons that interest rates in India are so high is that inflation in India is relatively high. This also used to be the problem in countries like Vietnam, which had historically had very high inflation and very high interest rates. But since they brought their inflation a lot more in single-digit bands, their interest rates also fell to single-digit bands, and those who bought currency forward benefited from that. These drivers can also be risk-on momentum trades, and the last strategy I'm going to be showing is a momentum-driven trade that we can look at. Now, what is your risk whenever you do a carry trade? Any of you who remember carry trades, either from the mid 1990s, where you borrowed Thai baht and bought US dollars, for example, or if you borrowed yen and bought Aussie dollars in the mid 2000s, whenever there is a market correction, whenever there's a big sell-off, the higher yielding currencies tend to fall and lower yielding currencies tend to rise. So low yielding currencies like the Japanese yen, the Swiss franc, tend to do well when there's a big market crash or market sell-off. And in that time, the higher yielding currencies like the Indian rupee will tend to lose value very, very quickly. The other risk is that when you're trading this with futures contracts, although I mentioned the notional value of the contract is 100,000 US dollars, you only need to put a fraction of that in margin. So if you're going into this with the idea that you're going to have a $100,000 account, but you're going to be trading $2 million worth of FX futures, if it moves against you 5% in any direction, your $100,000 will get wiped out. So that's one thing to watch out for whenever you trade futures contracts on margin. I mentioned earlier I was going to show you how to turn a US Treasury into an RMB bond by using futures contracts. This is an exercise I walk through in great detail in many of my fixed income workshops, where I start off by showing a $1 million US Treasury, in this case originally a 2-year note, which has 1 year left to maturity. So instead of buying, let's say, a 1-year dim sum bond, what I'm going to do is I'm going to put my money in this US Treasury, and I'm going to look at a few different scenarios where the renminbi may appreciate or may depreciate over time, but I want to see how is that going to affect the actual value of my treasury, and how is it going to affect it in renminbi. So if I were to convert this into renminbi right now, I would be converting it at the then spot FX rate of 6.74. But the forward FX rate that I could effectively buy would be 6.91. So that implies that the renminbi is going to weaken, but really when I trade that FX future, buying the renminbi at that cheaper price means that I've locked in that higher interest rate. I can either do that trade once by buying the December contract right away, or what I can do is I can walk down each of these trades step by step and roll them quarter by quarter. And which one you do, it really depends on whether you need to lock in the long-term rate and whether you can get enough liquidity in the long-term contract versus in the shorter-term contracts. In general, buying and rolling the contracts quarterly is a lot more liquid, but it also exposes you to the risk that if Chinese renminbi rates fall, you're not going to enjoy that higher yield pickup over the entire period of time. But any of you who are interested, if you want to send me an email afterwards, I will send a follow-up. I'll be happy to send you the spreadsheet if you want to play with it and prove to yourself that once you do this trade, whether the renminbi strengthens or whether it weakens, your actual amount of money and your actual yield at the end of the day is going to remain the same. You'll earn about 3.7% in renminbi, and you'll end up with 6.68 million renminbi. So that in a nutshell is how you turn a US dollar bond, whether a treasury or a high yield bond, into a renminbi product. Strategy number 2 is if you want to trade China A shares, or if you want to trade really any other renminbi denominated product, but you don't want to take renminbi risk. So as some of you who trade A shares may know, Interactive Brokers was one of the first brokerage firms that got our accounts on Stock Connect. So thanks to Interactive Brokers, I was able to trade Shanghai A shares right after Stock Connect opened, before actually many of the other banks here got approval to trade it for tax and other reasons. And that was actually a really good time because the A shares had a very quick run up afterwards. But as those of you with margin accounts know, those A shares trade in renminbi, and if you don't convert your money into renminbi ahead of time, you're going to have a debit balance in renminbi margin. And I'm going to show you on the next slide that the renminbi margin rates that Interactive Brokers charges are relatively high. So you'll notice that I didn't update the slide here. I very often do this trade with yen, because very often I have clients who say we want to buy Japanese stocks, but we feel that the yen is going to go down. We want to make money in yen terms. So one option is you can either buy Japanese stocks on margin, or you can convert money into yen, buy the Japanese stocks, and then sell yen futures in order to hedge the FX exposure. So even though I forgot to change yen to renminbi, the mechanics are exactly the same. You convert your money into renminbi, buy your A shares, and then you would trade the FX futures in order to hedge your FX exposure back into US dollars. So as mentioned earlier, the futures hedge gives you that effective 3.7% financing rate if you were in buying a renminbi position, as opposed to if you were to borrow renminbi on margin. Interactive Brokers on their website here charge 6.387%. Strategy number 3 is a standard FX momentum strategy, and this could be done as a strategy in its own, or it can be done as an overlay. By overlay, I mean the actual money in your account is invested in other things. You've invested in stocks or bonds. Like say, we often invest in a bond strategy. But we want to separate the question of whether we buy Japanese stocks or Chinese stocks from the question of how much of our money should be in yen and how much should be in renminbi. FX momentum strategies basically take currencies that are moving in a trend. So if a currency is moving up, you buy it. If a currency is moving down, you sell it. If you were to do this in a regular cash account, to take a short position in a currency would require borrowing that currency and paying whatever margin interest rate that currency had. But one other nice thing about futures contracts, and one reason I use them, is that they can be bought or sold equally well, and you get the institutional pricing, the same institutional interest rate either way. The example that I show here, with one of the currencies I earlier labeled as an appreciator, which was the Singapore dollar, is if going back to 1981, you were to run a very simple 20-day simple moving average strategy. The strategy is you run a 20-day simple moving average. If the US dollar Singapore dollar FX rate is above that moving average, you buy US dollars, sell the Sing. If the FX rate is below that moving average, you buy the Sing, sell the US dollar. So instead of a static strategy, which is the green line where you simply buy and hold Sing dollars, this is a dynamic strategy where when the currency is trending in one direction, you take one position, and when it's turning around, you flip it and trade the other position. Momentum strategies like this tend to work when the markets trend and when the markets move, and they tend to be disastrous when the markets trade sideways. So you'll notice most of the time this is actually done well when the Sing dollar has moved in trends, because as you know, the Singapore dollar is basically managed by the MAS as the way that they run their monetary policy. But since the global financial crisis, basically since about 2013, 2015, a Sing dollar has been much more range bound. It swung from about 1.25 Sing dollars to the US dollar to about 1.45. And as it's been going sideways, you end up buying high and selling low, which is what destroys a lot of momentum strategies. So that was strategy number 3. That could also be implemented with futures. And that hopefully was a good enough, useful overview of most of the things that you may have had questions about regarding trading currency futures, and specifically the 2 most liquid currency futures on the renminbi and Indian rupee on the Singapore Exchange. So to find out more about me, more about my firm, more about strategies and other things I write, please feel free to visit my website, www.gfmasset.com. I write several blog posts there that include 3 of those currency charts that we mentioned and several other strategies. And there's my contact information as well if you'd like to reach out, get a copy of that spreadsheet, or discuss something else. So now I think it's a good time to open the floor to questions and see if any of you would like to ask questions about currency trading strategies.
Well, Tariq, I'm not seeing any questions come in at this time, so it would be a good spot for us to conclude today's webinar. I want to thank everyone for joining us today, and special thanks to SGX for bringing us today's webinar. And Tariq, thank you so much for your efforts here today and the information that you've brought to us. Now, I do want to remind everyone that we have been recording today's event, and each of you will get a direct link to today's broadcast soon after the session ends. So if you do have or want to come back and review any of the concepts that Tariq went over today, simply watch your inbox later on for a direct link to today's recorded playback. So thanks everyone for your participation. Have a great rest of your day all.
Thanks, Cynthia.
Thank you.
Thank you, Tariq. Oh, and thanks, Myron, for hosting today's event. Have a great day, everyone.